Hello, this is Utkarsh Jain and we are on to part 4 of 60-minute guide to accounting. Now in this section we are going to do certain problems which are slightly advanced nature on accounting. So now what we've already seen is that these are the transactions that we've already seen. First transaction where we started business with capital, and we know that capital was liability, second effect to be given in cash. Bank loan, liability, second effect to be given in cash. Purchase of building, 400, it is going to be an asset, second effect is reduction of cash. What new thing that we would see here is that there would be a depreciation that needs to be charged on building, and it is to be charged at the rate of 25%. Transaction number 1, we saw this transaction in the previous case where we said total sales made during the year 300,000. One new addition is that now 50% of these sales are made on credit. Transaction number 5, total expenses made during the year 100,000, out of which 40% of the expenses have been made on credit. Now using these transactions, let us prepare a balance sheet and an income statement. So let's draw our balance sheet. Let's use yellow. So this is going to be our balance sheet. Left hand side liabilities, right hand side assets, and also draw an income statement. This is our income statement. Left hand side is going to be expenses, right hand side is going to be income. Now let's go back and give effect to transaction number 1. Started business with capital of 500. So capital is going to be liability 500. Second effect is going to be in cash 500. Let's go back, see transaction number 2. Bank loan taken 100,000. So bank loan of course is a liability 100. Second effect that because we have taken bank loan, our cash is going to increase. So now the cash is going to become 600. Again the balance sheet is getting tallied, total 600 on the asset side. Let's go back. Purchase of building 400. Now we have two transactions here. One is purchase of building, second one charging depreciation on it. We'll see what it really means, but let's go back. Let's go to the building first and let's give effect of this transaction. So building 400. Building 400. Second effect, the fact that we have purchased an asset, our cash is going to reduce. So now the cash would become 200 because we paid cash worth 400. Now the next transaction is about depreciation, which says charge depreciation on building at the rate of 25%. Now to understand the concept of depreciation, first let's understand the concept of revenue expenditure and the concept of capital expenditure at times, which is also called as capex. Now what does it mean? Let us say that for business purpose we spend some amount, let us say 100,000. Now every time we spend amount, what we've learned till this time is that this amount can either be shown as an expenditure and second effect to reduce cash, or the alternative treatment is that we can show this amount as an asset giving second effect by reducing cash. That means every time some amount is spent, it can either be an expenditure or it can be purchase of asset. So every time some amount is spent and it is in the nature of expenditure, we would call that amount as revenue expenditure. But every time some amount is spent but it is in the nature of assets, we would call that amount as capex. So let's do an example. Let us say that we are in the business of manufacturing and we decided to spend 100,000 on certain repairs of our plant and machinery. Now what is the purpose of these repairs? The purpose of the repairs is to take care of the wear and tear of the machinery. That means it's a repairs which is in the regular nature, it's a regular business activity. Then we would simply say that it is a revenue expenditure for the business. But if these repairs are in the nature which are going to be some sort of an add-on to your existing set of machinery, it is going to do some value addition to existing set of machinery, it is going to add some extra feature to existing set of machinery, because of which your production might increase or your time to produce the same goods might decrease, and which would help you to earn some extra set of revenue for the periods to come. And in that case, we would simply say that this expenditure is capital expenditure. So what is the test? The test is that when I spend some money, do I get an immediate benefit by spending that money and I do not get any future benefit? If that is the case, that expenditure would be called as revenue expenditure. But when I spend some money and the benefit that is to be received would be received over the period of next 2 years, 3 years, 4 years, in that case, that expenditure would be called as capital expenditure. And that is the reason why when we purchase an asset, that asset is shown on the balance sheet asset side and second effect is given by reducing cash. Now, let's do one more example. Let us say that currently for a manufacturing company, there is some process which is done manually. So there is a manual process which is done, and to amount which is being spent on this manual manufacturing process is, let us say, 10,000 every day. This is the amount which is being spent for this particular manual process. Now what company decided is that instead of spending this amount, let us procure a machinery. And the cost of this machinery is going to be $200,000. The amount at which this machinery would be procured is 200. Now, this 200 is a capex, it's a capital expenditure. That means it would not be shown as an expenditure immediately on the income statement. But does that mean that life of this asset is indefinite? Does it mean that this asset can be used for indefinite period of time? The obvious answer is no, that life of this asset is going to be limited. So let us assume for simplicity that life of this asset is 4 years. So what it really means is that by the end of 4 years, the value of asset is going to be 0. It's going to be worthless in 4 years. So what we need to do is that we need to reduce the value of this asset every year by 50,000. So year 1 we will reduce the value by 50,000, year 2 50,000, year 3 50,000 and year 4 50,000. So that value of asset by the end of the year would be, end of the 4 years would be 0. Which means value of asset at the end of year 1 would be 1.5, it would be 1, it would be 0.5 and value of asset would be 0. Now, the fact that we are reducing the value of asset every year due to the wear and tear or use of the asset, therefore, this reduction in the value of asset is called as depreciation. So what is depreciation? Depreciation is the reduction in the value of asset. Now, once we've understood depreciation, so let's go back and give treatment to this particular accounting transaction. So charge depreciation on building at the rate of 25%, which means 100,000. 25% of 400,000, which is 100,000. Now, what we know is that depreciation is reduction in the value of assets. We would say less depreciation of 100,000, and therefore the value of asset would now become 300. What is the second effect? Second effect, depreciation as an expenditure. So we would simply say depreciation 100. Now see a very important difference here. That depreciation was shown as an expenditure, which is 100. The second effect that we gave is that we did not reduce the amount of cash. But on the same balance sheet asset side, we went and we reduced the value of asset. That means that when we charge depreciation, we don't really have to pay any cash to anyone. And that is the reason why depreciation is called as a non-cash expense. That we do show it as an expenditure. We do show depreciation as an expenditure, but expenditure is not a cash expense, it is a non-cash expenditure. Let's go to the next transaction. It says total sales made during the year is 300,000, out of which 50% is made on credit. Now we've already studied accrual system, which says that amount of cash which is being received is not important to determine revenue, which means that entire sales of 300 would be written on the income side. But when we have to give the second effect of this transaction, that is the time when we have to worry about how much of this sales was received in cash and how much was credit. The fact that we have received only 50%, our cash should be increased only by 150, half of 300. So the total amount of cash is now going to become 350. But then how do we give effect to that remaining 150? Now the fact that we made a credit sales, we are supposed to receive that 150 from our debtors. That means the people who are supposed to pay money to us. So these people are either called as debtors, to be spelled as DEBTORS, B being silent, or these people are also called as accounts receivable, AR, accounts receivable, and the amount of money that we are supposed to receive from these people is 150. So again, repeating the same transaction, sales entire 300 was shown on the income side, and then it was given two effects. 150 was added to cash, remaining 150 was shown as accounts receivable on the balance sheet asset side. Now let's go and give effect to the last transaction. Total expenses made during the year 100,000, 40% are on credit, that means 60% are on cash. So now, no matter how much is cash, how much is credit, the entire expense of 100 would be written on the expense side. Now, but once that is done, to give second effect, we need to worry that how much was credit. And what we know is that 40% of this expense was on credit, that means 60% was on cash. So now, from our cash, we need to reduce 60 because 60 was in cash. So when we reduce cash of 60, total cash will become 290. And the second effect would be that since now we are supposed to pay this expenditure, that means it is a liability, and this liability is generally called as outstanding expenditure, and the amount of this liability is 4040. Now once we have given effect to this transaction, we have done all the posting. So what we need to do now is we need to calculate the final amount of profit, and final amount of profit, total income is 300, total expenditure is 200, that means the total amount of profit is going to be 100. This amount of profit should be transferred to the balance sheet. So we will say reserves, amount of reserves are 100. Then we'll take total of this side, so 600, 740. So total is 740. Let's take total on this side. So this would be 340, 440 and 740, and our balance sheet tallies. So again, which all sources of funds do we have? Owner's contribution 500, bank loan taken 100, 40 is the liability, that means we've made some expenses but we've not paid these people, and the amount of profit reinvested is 100. And what is the application of these funds? 300 have been applied towards the building, 150 is the accounts receivable, these people are supposed to pay us back, and cash 290. So again our balance sheet tallies, and with this we will finish our 60-minute guide to accounting. The purpose of this guide was to give an overview understanding as to what a balance sheet really means, what an income statement really means. The purpose was not to go into technicalities and the formalities of the presentation. So